Okay, hi there, everybody. I am doing this recorded lecture for chapter 3, or excuse me, chapter 23. We're going to start chapter 3 together, chapter 23 together on Monday. And so in chapter 23, we're looking at the statement of cash flows. And luckily for us, we've already gotten some practice with the statement of cash flows. So a lot of this will look familiar to you, but we're going to just introduce like a little bit more difficult statement of cash flows, sometimes where we got to go back and look at the T accounts for accumulated depreciation and the asset equipment accounts and things like that. And so it's just going to get a little bit more difficult, a little bit more complicated for us. But otherwise, hopefully we kind of remember the format of the statement of cash flows and we feel pretty good with it already. So I'm going to share my screen with you and get the PowerPoints pulled up. And so chapter 23, again, statement of cash flows. And I actually meant to grab a copy of the grab the textbook out of my car. Since I haven't been feeling good, I haven't even gotten any of my books out of the car and did any work. But it's okay. We have it here in the PowerPoint, and then again on Monday we'll get practice with it together in class. So anyway, chapter 23, some of these main learning objectives that we're looking at. Describe the usefulness and format of the statement of cash flows. Prepare a statement of cash flows. Contrast the direct and indirect methods of calculating net cash flow from operating activities. Discuss special problems in preparing the statement of cash flows, and then explain the use of a worksheet in preparing the statement of cash flows. So statement of cash flows is what we're talking about here. Okay. So primary purpose to provide information about the company's cash receipts and cash payments during a period. And then to provide cash basis information about the company's operating, investing, and financing activities. And so, when we look at preparing the operating section of the statement of cash flow, basically, we're going to start with net income, according to the accrual method from the income statement, right? We're going to start with net income. And then we're going to make adjustments to get that net income to a cash basis net income, essentially. Anything that has either a positive or effect or an increase on the statement of cash flow, or anything that has a negative effect or a decrease on the statement of cash flows. Right? We're basically going to take that net income that was calculated using the accrual method, and then we're going to make adjustments to it to get it to the cash basis method, essentially, right? So it provides cash basis information about the company's operating, investing, and financing activities. So it helps us assess the ability to generate future cash flows, right? It helps us assess the entity's ability to pay dividends and meet obligations or liabilities. It also gives us or lists the reasons for the difference between net income and net cash flow from operating activities. Because again, net income, this is from what we calculate using the accrual basis, right? So the revenue recognition principle, the expense recognition principle, right? And we adjust those to get to actual cash flow, right? So cash and non-cash investing and financing transactions provides information about investing and financing transactions as well. And I'm not sure why my little clicker isn't working here. Huh, okay. All right, so classification of cash flows, operating activities, investing activities, financing activities. Again, operating activities, this deals with our normal business operations, mainly current assets, current liabilities. right? So we're looking at, revenues that came in versus expenses that went out, and what was the overall result from operations, right? Those are our operating activities. Investing activities, just like it shows here, changes in investments and long-term asset items. And then financing activities, changes in long-term liabilities and stockholders' equity. All right, so classification of some of these operating activities. Again, there can be inflows or outflows. So obviously cash inflows are additions, or we're adding to cash. Cash outflows are subtractions, or we're subtracting from cash, right? So some of these operating cash inflows and outflows, inflows can be from the sale of goods or services, and from returns on loans, either interest return or on equity securities, dividend return. So interest revenue, dividend revenue. Cash outflows to suppliers for inventory, to employees for services, to government for taxes, to lenders for interest, or to others for miscellaneous or other expenses. And so those are all income statement items. And then we look at inflows and outflows from investing. So inflows from investing from the sale of property, plant, or equipment, the sale of debt or equity securities, or from the collection of principal on loans to other entities. Cash outflows to purchase property, plant, and equipment, to purchase debt or equity securities of other entities, or to make loans to other entities. And then financing, cash inflows and outflows, financing inflows from the sale of equity securities of our company, right? Because up here in investing, it says from the sale of debt or equity securities and other entities, right? But if we're selling our own equity securities, like common stock, for example, right? Then that's a financing activity. And then from the issuance of debt, if we issue bonds or notes payable, and then cash outflows to stockholders as dividend, or to redeem or pay off long-term debt or reacquire capital stock. All right, so the basis for the recommendation by FASB for the statement of cash flows is to actually use cash and cash equivalents. Cash equivalents are short-term, highly liquid investments that are both readily convertible to known amounts of cash, and so near their maturity that they present insignificant risk of changes in the interest rate. So when we think about the, cash and cash equivalents, that's not only liquid cash, but then cash equivalents are, again, investments, short-term investments, for example, that are so close to their maturity that we're not going to have big changes in the interest rate or the big changes in the value of the investment, right? And then down here, it says generally only investments with original maturities of 3 months or less qualify under this definition. And so when we think about the statement of cash flows, again, we've got the three main sections of the statement of cash flows: the operating section, the investing section, the financing section. When we think about the operating section, we can prepare the operating section using either the direct method or the indirect method. And the indirect method, just like your book tells us, the indirect method is used most often. So that's what we're going to focus our attention on. The investing section, the financing section, those are both exactly the same, right? So these two are same under either method. Under either method. Right? Those are both the same under either method. It's only the operating section that is a little bit different depending on whether the direct or indirect method is used. Again, I think, your book tells us that the indirect methods used like 98% of the time or something like that. So that's what's used most often. So that's what we'll get the most practice with. But just like it shows down here, we report inflows and outflows from investing and financing activities separately. And again, that doesn't matter whether we're doing the direct method or the indirect method. So here's an example of the statement of cash flow format. And so you see up here, these are our operating activities. And so here's in this case, net cash used or provided by operating activities. Here's our investing section, right? Here's investing activities. So then we arrive at net cash used or provided by investing activities. And then here's our financing. Oh, let me go back a little bit. I include a little bit too much there. Here's our from financing activities, the financing section. And again, we're listing either net cash provided by if there's a net inflow, or net cash used by if there's a net outflow. And maybe I'll circle that. So provided by, then we're going to have a net inflow. In other words, we're going to have a positive number, right? If it's used by, then we have a net outflow. So, you know, once we add up all the inflows and outflows, it's a net negative or a net decrease. And so again, we see here the net increase or decrease in cash, and we look at that number, and then we add cash at the beginning of the period to hopefully equal cash at the end of the period if we have prepared it correctly, right? That's that basic format. Okay, so preparation of the statement of cash flows, we need to look at our comparative balance sheet. So that's 2 years of balance sheet data. Because we take the beginning versus the ending balances in most of the line items. And then our current income statement data, we need our net income from there. We need any depreciation expense, amortization expense, depletion expense. If we had any gain or losses on the sale of assets, we would use that information as well. And then some selected transaction data that they give us, and we kind of call this like other information or other important information type deal. And then the 3 major steps. First, we calculate the difference in cash. We determine net cash flows from operating activities. That's the biggest section of the statement of cash flows. And then we can determine net cash flows from investing and financing activities. And then again, we reconcile it all at the bottom by taking that net increase or decrease in cash plus the beginning balance to then hopefully arrive at the ending balance in cash. All right, so here's an example. It says Tax Consultants, Inc. started on January 1st, 2016, when it issued 60,000 shares of $1 par value common stock for 60,000 cash. The company rented its office space, furniture, and equipment and performed tax consulting services throughout the first year. The comparative balance sheets at the beginning and end of year 2016 appear in illustration 23-3. Illustration 23-4 shows the income statement and additional information for tax consultants. So here are the comparative balance sheet. Again, we just started the company at the beginning of the year, right? So it, started at beginning of year. And so that's why we've got obviously all 0 balances. And then so at the end of the year, we've got cash of 49,000, accounts receivable of 36,000, and the total assets 85,000. Then we have accounts payable of 5,000, common stock of 60,000, retained earnings of 20,000. So again, liabilities and stockholders' equity 85,000. And then they give us the income statement. So that's the comparative balance sheet data, right? Comparative meaning 2 years. We need 2 years to do the statement of cash flows. And then the income statement for the most recent year ended, in this case, 2016. And this shows our revenues, operating expenses, income before taxes, income tax expense, and net income. So far on here, we don't have any depreciation expense. And so we won't be using that, but we will be using this net income figure here for our statement of cash flows. Remember, in our operating section, our net income from the income statement is our starting figure. And then we make adjustments to adjust it down to cash basis net income, essentially. And then they tell us here that we paid out a dividend of 14,000. That'll be for our financing. That'll be used in financing. So this is used for the operating section. And then this is going to be used for the financing section. We don't have any investing activities here, right? Because we have no fixed asset investment. So we don't have any investing activities here yet. Okay, so, it's showing us here the first step, determine the change in cash. And in fact, we could just say determine the change in all line items because that's what we're doing here. So cash increased 49,000, accounts receivables increased 36, AP increased 5,000, common stock increased 60,000, retained earnings increased 20,000, right? So not only are we determining the change in cash, but in fact determining the change or the increase or decrease in every account. Step 2, determine the net cash flow from operating activities. Again, company must determine revenues and expenses on a cash basis. We need to eliminate the effects of income statement transactions that do not result in an increase or decrease in cash. For example, depreciation. Although we claim a depreciation expense, it doesn't result in an increase or decrease in cash. Same thing if we have a gain or a loss on the sale of an asset, it doesn't actually result in an increase or decrease in cash. So those are some of the effects, amortization, depletion, right? Some of the effects, that could be on the income statement that do not actually result in an increase or decrease in cash. So basically what we're doing here, again, I've said this a couple times, we're converting net income to net cash flow from operating activities. And in our case, we're going to be using the indirect method. That's the method used most often. Okay, so when we think about net income, right, our, revenues minus expenses equals net income. So those are recognized revenues versus incurred expenses. And this is based on the accrual method. So if we think about it, recognized revenues, this includes revenues that were recorded, but we haven't actually been paid the cash for. So we have to make an adjustment to get net income from the accrual basis to the cash basis, basically, right? And this, on the flip side of that, this includes expenses we've incurred that maybe we've debited the expense, it's been recorded, and so it showed up on our income statement, but we actually haven't paid the expense yet. It's still a liability. So it hasn't actually impacted cash yet, right? And so that's what I mean by we have to get the accrual basis net income is what this is, right? The accrual basis net income, we have to convert that to the cash basis, essentially net cash flow from operating activities. So we've got to eliminate non-cash revenues. We've got to eliminate non-cash expenses. And so here it's showing us an example, or, at least the next few clicks, or we're going to go through examples of how each one of these things show up. So this $49,000 increase, well, I didn't do that very good. This $49,000 increase in cash, it's going to end up showing up down here, right? Net increase or decrease in cash. So we're going to see that. And then it's just going to show us where each of these line items are going to go. And so we can see here, and I'm just going to click through the whole thing until it gets it all on here for us. All right. And so we see that accounts receivable increased. To make that adjustment, we decrease that, right? We see here that accounts payable increase, that has the same effect. So that's an increase on cash. And remember, like we said, any increases, in our assets, any increases have opposite effect. So these are both increases. They have opposite effect on statement of cash flows, right? Now, when we get to liabilities and down in the bottom section of the balance sheet, these have same effect. So as we saw with accounts payable increased, so that also increased cash. You know, essentially we could look at it like we increased accounts payable, we owe 5,000 more than what we did, and that's because we did not pay cash. And so that had a positive effect on cash because we incurred this debt. We haven't, we haven't paid for it yet, basically, right? Okay, so overall, we had net, and this was our net income, 34,000 back on our income statement. But then we look at adjustments to reconcile. Here we are, adjustments to reconcile net income to net cash provided by operating activities. And so we're subtracting or decreasing for the increase in accounts receivable. We're increasing for the increase in AP. Overall, it's a net decrease of 31,000. And so we've got net cash provided by operating activities of 3,000, right? Again, we don't have any operating activities, investing activities. Generally speaking, investing activities would be right here, but this is the first year of operations. We didn't have any investing activities, right? No investing activity. So it goes right to the financing section. The issuance of common stock, that increased our common stock. It has the same effect. So it also increased on the statement of cash flows. And then that cash payment of dividends, that does decrease our cash, decrease our retained earnings. So it's a decrease to cash in the financing section. Again, net cash provided by financing activities, 46,000. So 3,000 now plus 46,000 equals 49,000. Cash at the beginning of the year was 0. So cash at the end of the year, again, 49,000. Okay, and it's showing you that statement of cash flows here a little bit bigger. We just looked at this, but now it's showing it to you here a little bit bigger. Sources of information for the statement of cash flows, again, comparative balance sheets, 2 years. Analysis of the retained earnings account, increases or decreases there. All changes that have passed through cash or have resulted in an increase or decrease in cash. And then also any write-downs. This would be like impairments, or allowances, like allowance for doubtful accounts, for example, any impairments or allowances, amortization charges, or similar book entries like depreciation, since they have no effect on cash. All right, so the indirect method, again, it's just showing us overall any additions to net income or subtractions or deductions from net income. And I'm not going to read through every line. You guys can look at this in the book. We're going to, of course, get practice with these in class together. Several of these statement of cash flows in class together. All right, special problems in the statement of cash flows preparation. So again, we have to make adjustments to net income. We take that accrual basis net income that we calculated on the income statement. We adjusted essentially to cash basis net income. So depreciation and amortization, any effect that these have. So if we claim depreciation and amortization, we have to add back to net income from operations. Because again, if you think about when we claim depreciation or amortization on some of these long-term investments or long-term assets, we subtract that from revenue to arrive at net income, right? That's an expense. So that's subtracted from revenue to arrive at net income under the accrual basis, but it doesn't actually reduce our cash, right? So we've got to add that back in. Post-retirement benefits, company must adjust net income by the difference between cash paid and the expense reported. Changes in deferred income taxes affect net income, but it have no effect on cash. So again, we have to either add or subtract those back in. Equity method of accounting, net increase in the investment account does not affect cash flow. So again, that would be something that we would need to adjust. Companies must deduct the net increase from net income to arrive at net cash flows from operating activities. Losses and gains claimed on the income statement. Again, a loss is added to net income. A gain would be subtracted to compute net cash flow from operating activities because the loss is a non-cash charge on the income statement. Same thing with a gain. Company reports a gain in the statement of cash flows as part of the cash proceeds from the sale of equipment under the investing section. Thus, it deducts the gain from net income to avoid double counting. So we have to handle it two places, basically, right, is what it's saying. So we report it as a gain on the statement of cash flows as part of cash proceeds from the sale of equipment under the investing activities. And then we deduct it from the gain from net income as part of the operating section, right? To avoid double counting it. Stock options, cash is not affected by recording the expense. The company must increase net income by the amount of compensation expense from stock options in computing net cash flows from operating activities. Unusual or infrequent items, companies should report either as investing activities or as financing activities, cash flows from unusual and infrequent transaction, and other events whose effects are included in net income, but which are not related to operations. All right, accounts receivable. When we think about that accounts receivable account, and we've gotten some practice with this before, where when we think about accounts receivable, we know that a portion of them are going to be uncollectible. And so that's where we create that allowance for doubtful accounts. And remember that the journal entry, when we estimate our allowance for doubtful accounts, we debit bad debt expense. It's supposed to be a B. We debit bad debt expense, we credit the allowance for doubtful accounts. And so when we think about that allowance for doubtful accounts, just like it shows here, that, we're claiming that expense, which is reducing net income based on the accrual basis, but it's not actually impacting cash. And so it says, because an increase in the allowance for doubtful accounts results from a charge to bad debt expense, a company should add back an increase in allowance for doubtful accounts to net income to arrive at net cash flow from operating activities. Or in other words, we need to use the overall net accounts receivable increase or decrease. And so that's what they're showing you here, the indirect method. So one method of presenting this information in the statement of cash flows, this indirect method, essentially, we're looking at the increase in accounts receivable versus the increase in the allowance for doubtful accounts to get the net amount, or simply showing the net amount like we have been doing to this point, like we have been getting practice with to this point. Okay, other working capital changes. So remember, working capital, the formula for this, current assets minus current liabilities equals our working capital, right? That's our formula for working capital. So it says some changes in working capital, although they affect cash, do not affect net income. Examples of these are the purchase of short-term available for sale securities, or the issuance of short-term non-trade note payable for cash, or cash dividend payable. So these are some other things that we have to take into consideration when thinking about making adjustments to that statement of cash flows. Net losses. So just like it shows here, if the net loss is 50,000 and the total amount of charges to add back is 60,000, then net cash provided by operating activities is 10,000. So instead of starting with a positive number, if it's a net loss, we're starting with a negative number. We're doing the same adjustments, right, to reconcile net income to net cash. And, whatever the net effect is, we've got net cash either provided by or used by operating activities. Okay, and then significant non-cash transactions. These are reported at the very bottom of the statement of cash flows, if applicable. Common non-cash transactions that a company should report or disclose include the acquisition of assets by assuming liabilities, including capital lease obligations, or by issuing equity securities. So, for example, if we trade some of our common stock for a building, or if we trade some of our common stock for equipment, right? That's a non-cash transaction. So exchanges of non-monetary assets, refinancing of long-term debt, conversion of debt or preferred stock to common stock, or the issuance of equity securities to retire debt. All right, and then finally, the use of a worksheet, and this is why I meant to go and get my book out of the car real quick, and I forgot to do that so I could point you to a page number to look at, but we'll look at it in class together. But essentially, if we're looking at a worksheet, step 1, enter the balance sheet accounts and their beginning and ending balances in the balance sheet accounts section. Step 2, enter the data that explain the changes in the balance sheet accounts and their effects on statement of cash flows in the reconciling columns of the worksheet. And then step 3, enter the increase or decrease in cash on the cash line at the bottom of the worksheet. This entry should enable the totals of the reconciling columns to be in agreement. So again, I wanted to point you to a page number, but unfortunately, I forgot to go get my book out of the car, and I don't want to take up your time. We'll look at it in class together. Anyway, this is our last slide, so hopefully that's making okay sense to us, and we will get started again with this statement of cash flows on Monday. Let me stop sharing this for a second here. Okay, guys. Yeah, so, luckily back in chapter, whatever it was, I can't remember now if it was, I believe it was chapter 4. So chapter 4, we got some practice with the statement of cash flows. You guys actually had to prepare this statement of cash flows for one of your exams in Intermediate Accounting 1. And so you have gotten practice with this before. And so we'll build on that and get more practice with it in class together on Monday. So I'll see you guys then. Bye-bye.